G.Chokkalingam, MD and CIO at Centrum Wealth Management, joins us on the show. Mr. Chokkalingam, hi, afternoon. Good pop for the market today, but would it be only prudent to start taking profits in the rally that we're seeing right now?
The market is behaving as if the India's problems were only monetary. But unfortunately, there are five set of problems. Monetary problem, yes, you have European instability, very high interest rate cycle. It's also a fiscal problem. You have worsening fiscal balance of the government. Third problem is deceleration in the industry. There are no signs of improvement. And fourth problem is banking NPAs, which is growing beyond what is the tolerance level. And fifth is a set of uncertainties. You have uncertainty coming from Fed. You have the uncertainty from the election. And you have uncertainty in terms of long term from the two bills which we have passed recently, food bill and the land bill. And finally, uncertainty regarding whether S&P and Moody would downgrade India's rating. So there are five sets of problems. We have no answer. And therefore, I firmly believe that the run-up is beyond what fundamentals deserve. And it is still time to be defensive. And, in terms of allocation to equity and also allocation within equity asset class, the investors should be very defensive and continue to follow defensive approach and use this rally, to tactically reallocate within equity asset class. And in fact, one can use this rally to book, profit or marginal losses in PSU banks and, then follow the defensive strategy.
You have a similar strategy in private banks as well, because we've seen some of these private banks really rally sharply in trade, whether it's ICICI Bank, HDFC Bank. Do you think this rally provides the opportunity for investors to exit these stocks because in the near term, these counters are likely to be under pressure?
I would certainly believe that the private sector banks are a better place compared to public sector banks. However, sector as a whole will have a lot of stress in the next 3 to 6 months. So therefore, the prudent strategy would be to, instead of exiting completely, you reduce the overall allocation to the banking sector. Traditionally, we used to go beyond 22% whenever we are overweight on banking sector. Now I think the time has come to reduce to 10, maximum 15%. So therefore, I would suggest even in the large private sector banks, reduce your allocation and the overall banking exposure you try to reduce to, anywhere from 12 to 15%.
What's your view on the IT sector as well? Do you think investors who've made some money should look to get out of this sector, or do you think, like you were saying in the beginning, that one should still stay invested in defensives like IT?
Certainly the investors should stay invested in IT sector. The sector would once again get back its favor. Because, as I said, there are no, confidence about the stability of rupee at least in the next 3 to 6 months. And therefore, staying in IT sector would be the most defensive approach. And I would suggest having around 15% of the equity exposure to the IT sector. Probably what one can do is that, they can book profit in the large IT companies like Infosys, which I believe would remain as an underperformer, and move to mid-cap IT stocks as well as the IT companies owned by the MNCs. Since rupee has crashed by nearly 50% in the last 2 years, there will be a greater attraction for MNCs to, think of acquiring or delisting the Indian subsidiaries. And mid-cap ITs, again, what happened to Exaver, we think will happen to 1 or 2 more players in the industry, and that will increase the valuation multiple. So therefore, I would suggest these two set of IT stocks and have minimum 15% exposure to the IT sector within equity portfolio.
Mr. Chokkalingam, really appreciate you taking the time out and speaking with us today.